Hello, everyone. I'm Carrie Delgott, Wescott's Chief Operating Officer, and I'm here with Mark McCarron, our Chief Investment Officer. It's great to see you, Mark.
Hi, Carrie. Good to see you as well. And as usual, there's quite a lot to talk about today. A lot of things going on in the economy and the market. And really, the theme of today is really to talk about the Fed's challenge, right? How do they manage the inflation targeting that they're doing and also maintain financial stability? So, a lot to talk about today.
I couldn't agree more. A lot going on. So let's jump right into some of the topics we've highlighted here. A common theme throughout is everyone's favorite inflation. Fed policy and inflation expectations continue to dominate global markets. So, Mark, why don't you talk to us a bit about the impact and expectation for the remainder of the year? And of particular interest to many, how the aggressive rate hikes contributed to the collapse of Silicon Valley Bank and Signature Bank.
Yeah, those topics are definitely top of mind. And what we wanted to talk about today is really the trade-off that the Fed has to deal with, right? So as you mentioned before, we're all talking about inflation, what the expectations are, and I think perspective is important. If you look at this chart, what we're showing is on the blue line is inflation, CPI, and it peaked back in June of last year at about 9%. I think that's really important, but it peaked at 9%, and then the Fed started to really be aggressive, as you mentioned, on their rate hiking. So this orange dots there, the Fed funds rate, and now they're up to about 4.75%. That's after 9 rate hikes in the last 12 months, which is really astonishing. I do think that those are having the desired effect. If you look at where CPI is today, it's gone from 9% year-over-year growth rate to about 5%. So it continues to decline. We're actually in the midst of a or disinflationary environment. But the Fed can only go so far before it starts breaking things. That's sort of what the history of finance tells us, and the markets tell us that the Fed has so much leeway. But you get to a point where rates maybe get a little bit higher than the market's comfortable with, and then you start seeing challenges. So the challenges you referred to, the failure of Silicon Valley Bank and Signature Bank, we think are largely unique to their specific situations. But it is important to note that this is really an effect of the rate hiking cycle that we're in the moment, and why those banks failed. We'll talk a little bit about in a moment, but it's a sign that maybe we're at the end of this rate hiking cycle, not the beginning. And I think the future of any rate hiking will depend really on the employment situation, which we'll talk about, but also are we going to get some slowdown in bank lending because banks are a little nervous about the environment of the higher rates. So let's talk a little bit about that real quick. So on the right-hand side, we see a chart here, which really illustrates, I think, pretty clearly what happened in the middle of the first quarter. That blue line there is the regional banks of the United States. The performance was riding quite along with the broad market, and then fell by 25% almost overnight as Silicon Valley Bank and Signature Bank within a week failed. And the causes are unique to them, right? They had some clients who were very concentrated. They had a lot of money in deposits. They started taking those deposits out, and they had to meet those deposits withdrawals basically by selling securities on their balance sheet. And those balance sheet securities were government bonds that were down in price. So you had a double impact, a negative impact of withdrawals coming out and also selling at a loss. That spooked the market. It spooked basically customers at these banks, and really caused a old-fashioned bank run, which we haven't seen in a long, long time, but it can happen today in today's world. But interestingly, I think what's really important about this sort of situation of bank failures versus maybe 2008 and 2009 is that as the banks were failing, there was actually a flight to safety. Investors were buying bonds, government bonds, and actually pushing those prices back up, yields down. And in a sense, that actually improves the financial situation of some of the banks that we're talking about, the regional banks that suffered. So, which is the opposite of what happened in 2008 and 2009, where there's a fear, and that fear drove further declines in values, which caused more fear. This is not that case today. I think it's really important to say. So, finally, just Wescott does not own Silicon Valley Bank, and instead emphasizes in their portfolios larger, systematically important financial institutions, or SIFI, basically SIFI, and they've benefited from the positive flight that is coming out of the smaller banks and into the bigger banks. So really important to note the unique nature of the bank failures, but it is an impact, it is a consequence of what the Fed has been doing over the last year.
Now let's switch topics. On another note, it's really surreal that we're just past the 3-year mark of when the world shut down as a result of COVID-19, the beginning of the pandemic. Take us back over that 3-year period and where we are today compared to where it all started in March of 2020.
Yeah, it is surreal, isn't it? I mean, I can remember exactly where I was. I think we all could remember exactly where we were when we heard that we're all heading home. What we thought was going to be for a week, it turned out to be years of working remotely in the midst of the shutdown. And the fear of the unknown that followed those early days was very dramatic in the market in terms of volatility. Um, but I would also say it turned out to be an opportunity for long term investors. So, what happened in the early days and the first couple of months of the pandemic was that the government stepped in and provided significant fiscal and monetary policy. So, fiscal is government spending, monetary stimulus is basically what we just talked about, the Fed cutting rates to zero. And what we're seeing today is a slow reversal of those pandemic era um, strategies. But there was needed at the time to provide liquidity to the market and kept the economy going. But what we're seeing on the right hand side here in this chart is that both the S&P 500 index, which is the US market, and the MSCI EFA index, which is the non-US developed markets, they are up on an annualized basis over the last 3 years pretty dramatically. In fact, the S&P is up 18%, 18.6% annualized since March of 2020. And the non-US markets, while not as high or as large as the US, they're up 13% on an annualized basis. So despite some of the weakness that we saw last year as the Fed began to normalize their rate levels and interest rate policy, we're still looking at a very strong 3-year result in the broad markets. And despite the fixed income weakness that we saw last year, Westcott portfolios over the last 3 years have delivered strong, attractive annualized returns. And I think rewarding those who were committed to their long-term strategy despite the uncertainty, the volatility, and the fear that gripped those markets 3 years ago. Today, well, 3 years ago, pretty much this month.
Mark, as you know, one of the largest components of the US economy is the housing market. Housing prices surged over the last few years. Pandemic was a big part of that. Low interest rates, people working from home. And while prices remain high, mortgage costs are now increasing from that record low. How is this impacting the inflation expectation?
Yeah, everything was affected by the pandemic, right? And the housing market was not immune to that. So at the beginning, we weren't sure what the pandemic impact would be on housing, but it pretty clearly became evident that if we were going to work from home, demand for housing was likely to rise. And that's what we saw. And supply wasn't increasing. So what we saw is significant increases in prices. And most importantly, I think for this conversation is that housing represents one of the largest components of inflation, whether you measure it by the consumer price index or other indexes. And this chart, as you mentioned, Carrie, shows the year over year change in house prices reached about 20 to 21% in 2021. That's a massive change from history. Usually it's around a 5% increase year over year. It went 20% year over year. And what we're seeing, and by the way, that also contributes to what we saw was peak inflation. Coming down off of that peak in 2022 and 2023, we think it will, in fact, bring inflation lower. It's a little stickier, it takes a little more time. Say if you sign up for a year's rent, it's only adjusted once a year, so that will take some time to work its way through the system. But we do expect the fact that these prices are coming down to be a positive for inflation. But we also think about the risks associated with that, because there's housing. It's called a wealth effect, but as prices come down, consumers and homeowners are less willing to spend. And I think that's really important to note as we look forward to growth expectations in the years ahead. But now that the economy is fully reopened, mortgage rates, as you mentioned, have more than doubled. I see this decline in house prices not as really a negative, but as a return to normal. And so, as we expect here, the inflation rate to come back down over the next couple of months as a result of these house prices coming down. So, really, where we stand today and why it's important to think about inflation and the Fed and everything else is that that's really what's driving the market. The latest inflation report, while encouraging, it shows disinflation. It's taking a little bit longer than everyone wants to get back to the target allocation. But the Fed needs to be thoughtful about what other things could break if it were to go too fast. So I think what we're seeing is a nearing the end of that cycle. So what's the next risk? We talked about this last time, but the debt ceiling debate is likely to bring some volatility into the market. We do not expect the U.S. to default on its debt. So we don't expect a big dramatic bond market sell-off as a result. But we do think there's going to be a lot of talk and a lot of volatile headlines that could bring some uncertainty until a deal is reached. And then finally, the question of the day is, do we reach a soft landing? There's evidence that the inflation situation is coming down, employment's still strong, people are still spending. That's the definition of a soft landing, and we're hopeful that we're getting closer to that as we head into the second half of 2023. So that's really the outlook from us, and a lot going on as usual.
Thank you, Mark. Great update. If you have any questions or would like to discuss any of the topics we've covered in our webinar updates, please feel free to reach out to Mark or your advisor. And thanks for your trust in Wescott.